Hi there. Welcome to another edition of Talk Stocks. I'm your host, Keir Reynolds, and today I'm really excited to have Thomas George of Grizzle Investment Management, Grizzle Media. You've probably seen him on Twitter or X. He's an OG sort of the financial influencer space, if I can dare call you that. Thomas, how you doing today?
Kerr, how are you, man? Great to connect. We saw each other in Vancouver. You know what? I'm happy we could sit down virtually and powwow.
Yeah, well, I tell you, I was there in Vancouver. I kind of managed to get 3 conferences for the price of one, sort of deal. They're
Yeah.
back to back. But
Yeah.
probably my 1 minute, my favorite minute, was bumping into you and having a good quick chat. And thanks very much for hopping on.
It was great. Yeah. Well, thank you. And I'm happy we could, we could do something longer form than just, the bumping into each other in the hallways. But it's been an incredible time. I know you follow the mining space closely and Canadian growth, and it's just it's nice to see the stars finally aligned for all things Canada.
Absolutely. And before we get into all that and unpack sort of what, the different divisions and departments of your kind of business, maybe for those of my viewers that aren't sort of familiar with just exactly who you are, you've got a really interesting origin story. If you wouldn't mind doing what a lot of people don't like, maybe you could talk a bit about yourself. You went to school, I think, for engineering, and you ended up managing like $1 billion or something for TD. Maybe you could just walk us through a little bit about your background.
Yeah, so a little background is I went to Waterloo for engineering. I was environmental engineering. So, near and dear to me was the earth, right? Things that come out of it. So that was always of interest to me. And then, obviously as you evolve through school and you get a taste for the capital markets, that was something that I was for me, just applying that aspect of the technical side into investing was it was just exciting. And from there, I joined TD Asset Management for what I didn't know was going to be a long tour of duty, 17 years. So, if you would have asked me in university if I thought I'd be with one company, right out of university and for a very long time, I wouldn't have seen that path. But I think it is a testament to TD. TD is one of the larger asset managers in Canada. I think actually on AUM, probably the largest. So I got to get a good window into institutional money management, right? And a lot of that was from the risk management perspective. That was huge, and it's always left an imprint, and the quantitative side of that as well. But then also just the growth, right? And so I spent time in the UK in TD's offices there for just under 2 years, and that was looking at resources, but from an international perspective. And also, we also were looking at the portfolio construction. When you look at international portfolios, they're dynamic, right? And owning some in Japan and they also own some in Europe, how you put these pieces together to me was a really great growing experience of understanding the fundamentals of portfolio management, which, I think that really is the bedrock. I understand risk assets very well. Understanding how you marry those risk assets is something that comes through in how we run our portfolio of the Grizzle Growth ETF. But so that was the history of TD Asset Management. I wore a ton of hats in that time, as you can imagine. My final resting space was I was on the resource. So basically we had a resource franchise. I led that, which was encompassed basically all of the resource funds, the TD Resource at TD Energy at the time, which is now the TD Resource, the TD Precious Metals Fund. And then further to that, also advising on the resource component of our Canadian equity funds as well, which aggregate all of that. It was a good chunk of change in terms of institutional money management. It was an exciting time. That's where I met my partner, Scott Willis. I also had a historic relationship with a good friend of mine on the street, Chris Wood, who was head strategist at CLSA at the time, which was the top Asian brokerage. And then he subsequently had joined Jefferies. But through that whole piece, we had an opportunity to start something new, something fresh, something very different than the street, which was Grizzle, which was we said, listen, it would be an exciting time to do something not so institutionally facing, but more like open source, open mic. Let's not have the shackles of Wall Street, Bay Street, whatever that may be, of communication, right? And that was something Scott and I were very clear on, and same with Chris as well. Our view was that the cadence and just the way institutional research in general was communicated was boring, actually. And it still is, actually. Like, nothing's changed on that side. And so, we came out of the gate when we launched in 2018 with covering the cannabis sector, which was literally the craziest place like on earth at that time. If you were living, breathing any of this stuff, it was crazy. Our report was Canadian pot stocks, the overvalued haze of Canadian pot stocks. Because at that time, there were a ton of companies that we felt were grossly overvalued. Now, again, that was very controversial at the time, but I think fast forward now, there were tons of ups and downs through the whole period. There were opportunities. And this is like what I really love about growth and disruptive investing is that things change, narratives change really quickly. And unless, like, the value guy can say, I bought this, like, cigarette and I have the butt and it's worth something, I'm going to go to sleep in it and it'll come back in 10 years and it'll be worth something, right? The growth and disruptive investor does not have that luxury at all, right? And that reassessment is always something so critical. And that was a really interesting for. And then we got into all of the dynamics of basically what is the frontier of disruptive investing today. Everything from Uber to Beyond Meat to, like, we were covering all of the craziest trends. And, the nature of this, you get some right, really right, you get some wrong. But, like, it's the amalgamation of these that come together to become a disruptive portfolio. And our view is that when you do disruption, you're going to get things wrong. You always get things wrong. The whole part about it is, in aggregate, you have two levers. You have to get more right than wrong in general, like in your stock picking. But then the second piece is you have to be overweight those ones that you get right really well. Like, those are the two levers you have as a portfolio manager. And I think that is like an area that when we put together the disruption at a reasonable price portfolio, the Grizzle growth portfolio, we think about that always, just like sizing all the time, right? Because when you get a call wrong, and you're going to get calls wrong, you have to make sure you're risk managing that position, right? And that's an art. That's an art. So, you go from individual stock picking, hey, this is a good stock, like that's kind of classic. Let me tell you about a story. But then putting that together in the portfolio is far more dynamic because you're going to have some big W's, some big L's, and everything in between. How you basically put those weights on at the motherboard is what defines performance long term.
Excellent. So that's a good sort of segue for.
Yeah, I think I was just freestyling. I just was like,
no,
hey.
I love it. I love it. It's
and here
great.
I am today.
It's awesome energy. You're definitely going to win the award for most energetic guest. So keep it up. Just so those of my viewers not necessarily sort of familiar, you've got a few different sort of divisions within Grizzle. And Grizzle, the name alone, a pretty cool name, definitely not as stodgy as sort of like some of the banks and institutions. So yeah. You guys have some great swag, some hats and things that you guys are often wearing. So it's quite a brand as well. But you've got a couple different kind of divisions. Would you mind just explaining a bit about what sort of encompasses Grizzle now?
Yeah, great question. It was so we started with the whole research and media side. It's still very important to us, like in terms of just highlighting the opportunities across the spectrum of disruption and mining, and all of the areas that we're near. And we'll probably get into more of how we think about the world. And it's two form. And we think about it in terms of technological disruption, and we think about this area of commodities, which is near and dear to our hearts, that is grossly undervalued. And so how we come at this big picture is I think on the Grizzle media side, now we're very focused on basically the conference side of the business, right? And so we host our critical minerals roundtable. We host our annual commodity one-on-one conference, and then our hard money, which is basically the combination of gold, silver, and Bitcoin. And so the predecessor to all those as well was the first cannabis and psychedelic conferences. So, we'd built these out. And again, we're putting out conferences we think that work in the market, right? And so, for us, we'd started with the cannabis, and we learned a ton. But for, longer term, our view was that, this wasn't a sustainable sector from just from the fundamental basis. So, our desire to continue that conference was minimal. So for us, moving into new sectors where we were actually seeing the growth was exciting. And I think the commodity sectors were the most interesting because, the market hadn't gotten there yet, which was quite exciting, right? And so from hard money to critical minerals, all of this was well before Trump and everything that's come to fore. And so that for us was great. And so we enjoy doing that. And then we also have an in-person which I hope you can join us during PDAC. I hope you'll be in town. And that's been phenomenal. We started that last year. We'll have another night this year. We have a DJ. It's a party. It's a party. If anyone knows the Grizzle brand in Toronto, we party. So it's especially for PDAC, which is one of the biggest parties in I think in the world in terms of corporate. Like when you meet mining guys, they are very different than any other corporate animal. They are legit real people because they've seen the world. And that's the truth, right? Like, a banker has seen the inside of his cubicle his whole life, and that's reflected in his, talking to a banker, right? With exceptions, of course, right? But it's a pretty good, but like, the why I really do love the mining sector is that they've been to all four corners of the earth. That, they're open-minded about how they see the world, and their commodities are actually in demand. So that's always interesting. So for us, conversations with mining executives, folks in the mining industry, understanding the industry is always it's incredibly illuminating. And you're talking to good people. That's, I think, something very important to us. And then our most, our division that is our asset management is our Grizzle Growth ETF. Now, that ETF is on the New York Stock Exchange. It goes by the ticker DARP, disruption at a reasonable price. We have partners on that ETF, and one of them is Cambria Investments, a large investment manager out of California. Meb Faber, who's a phenomenal guy. He took a liking to what we were doing and has been a phenomenal partner for the disruption at a reasonable price ETF. And the bottom line of that was predicated on the view that disruption is real. The only challenge in the way the market was looking at disruption currently was that they were not taking a holistic view of disruption. The way we think about that is from a valuation perspective, right? So, much of the market, and I, not to malign ARK, but like, let's be frank, ARK Innovation had some challenges. And that's not just specific to ARK. The whole disruptive category is plagued with this issue that they are looking for anything that's bright, shiny, and has the tin case of a disruption. Whereas valuation is not even secondary, tertiary. It's like maybe we think about it, maybe we don't. This is so far out, space travel kind of stuff, right? And like literally, like if you think about it, like our view is that valuation matters a lot. And if you're thinking about it realistically, that sweet spot is between 4 to 6 years out. The historical view of growth was like in the next 1 to 2 years, you're like, okay, what's the world going to look like? Now you got to look 4 to 6 years. But when you look 10 plus years, you're talking about Mars versus the moon. Like, does it matter? No, none of this. It's like nonsense. So then when Elon comes out with a thing saying we're not as concerned about Mars and now we're thinking about the moon. Well, like, for us, it's like, that's kind of funny. But for like Kathy Wood's portfolio, that's like a real mess, right? Because like so much of your space travel stuff is kind of based on, this, like, so our view is that disruption is very real, but you have to have it at a reasonable price. And I think that's, in our numbers have underscored that. So we finished first percentile in US large cap growth last year. And at Morningstar, we're now a 5-star Morningstar fund, which is, it's for us, it's validation for what we believe in. And so we're excited. And we always manage this to a very core view of risk management at an institutional level. We believe that you can do disruption. It doesn't have to just be all like buzzwordy. You can actually have it really reflect where the world's going, which is AI and a real lack of future-facing commodities and, where the value is in the market. And so, we said putting that portfolio together with a core risk-managed lens would would yield a very exciting opportunity. So last year we were up just over 40%. Our 3-year CAGR is 32%. So per year. So it's been a great ride in terms of the DARP sweet spot.
And that's pretty amazing for like an ETF. This isn't like some hedge fund or something where you have ticket size or something. People can buy a few shares of this if they'd like, and it's a great opportunity for them to sort of get kind of the Grizzle thought process in an exchange traded product. Is that about right?
Yeah, absolutely. And so we just it's coming out today actually, our year-end letter. I think I shared it with you. And so yeah, it's so if you want to understand more about that, and we'll have that on our website as well. So we believe disruption is the future. We believe you can't have it without a valuation lens. Like, that's critical. And we believe the pillars of disruption are definitively AI and future-facing commodities. If you feel all of those make sense, the wrapper that
Sure.
we do it in disruption at a reasonable price for us, make it like it's just fits.
Now, a question for you. Valuation is like really key. It's always been key for me, but I notice, and it's just a question for you, that as a sector, is more successful, the perception of valuation changes quite a bit. So like an example would be, back, in 20, let's call it 2018, 2017, something like that. If you looked at mining exploration, it was a bit of a bear market back then. If it was a junior explorer that, had maybe a small resource, under many of these were under 25 million market cap. Sometimes you might have thought, well, that's a bit expensive. Capital is a bit more expensive. You'd have to put full warrants and long-term warrants on it to really sweeten. But now, I attended some of the same conferences you did, VRIC, and they were very well attended, very boisterous, very busy. But I was starting to hear that, valuation's cheap. Yeah, it's only 200 million market cap. And for somebody, again, I've been invested in the sector since 2005, and you've obviously managed massive capital in the sector at an institutional level. What do you say about like this perception of valuation changing as the sector's kind of working? How do you sort of see that and manage that when you say a reasonable price? Does that reasonable price move, or is it sort of something you guys kind of set in stone, or like, I don't know, what's your thought process around that?
Yeah. What? Yeah, great point highlighting just to change. Obviously, like that time where there were companies sub 25 million, and just even sub 100 million. There were a lot of companies that were just like, I would call it just, it was a tundra, tundra of opportunities, and that I would say, are we there? No, I would consider that deep value territory, and we were positioned there, and that did work in the fund. Where we look now is that the evolving landscape and how we think about value still hasn't changed, but now you can size those positions much higher, right? So, and this comes back to the sizing, right? And so at a $200 million company, as long as the fundamentals aren't like radically different, and in our view, the tailwinds have just gotten stronger, particularly in gold, silver, and on the critical commodity side. Now I'm looking at a company that, okay, so this is not a value proposition that was, this company's for dead, I'm picking it off the lifeline. All the things you described, like that was real, right? And I think this is where a lot of investors get challenged too, where they were involved in that early part. But I think a lot of people who were involved early appreciate, because they know the sector intimately, they can appreciate how things have evolved as well. But I think the way we think about value now is that, okay, so one, the large caps, I think, are fully valued. That's actually factual, right? Like there's no question Agnico Eagle is a world-class company, but like for anyone to say this is at a deep discount relative to all the other mining companies, that's just not factual, right? And so we in Disruption at a Reasonable Price would not own Agnico, even though I have a ton of respect for for what they've built and their strategy, which has all yielded out. Now, then furthering that lens is like, well, how do we think about value? Well, the value chain now is very real. It's actually better than ever. if you think about my risk around getting a double or a triple, right? So if I look back at that sub 25 million market cap range that you described, like that whole kind of like period, like call it 4 years ago, plus where you're looking at a period where, yes, the upside was significant, but your confidence band was probably just as big, right? So how much capital could you put to work? Like if you're a prudent investor, let's be frank, it's not a lot, right?
Yeah.
You have to wait for things to evolve. Now it's more interesting in the sense that you've got bigger companies, yes, but your confidence interval band now is much tighter. So how much capital can you put to work here? Quite a lot, right? And other investors as well. And then you have this food chain effect where the large caps still don't have resource. And so the best way that they can add resource to their balance sheet, right, to grow is by purchasing mid small cap producers, right? Or developers that will end up becoming producers, right? And that's always kind of been the active exploration has been offshore. Like that's been something that's been standard in the market. Now, the problem is that if you were an investor in a small mid cap before, you weren't happy with your acquisition price, right?
Yeah.
Right? Like it was just like, okay, but like, you wanted to see this bigger payday. Now, I think the type of M&A that we'll see is you'll see a lot of very happy faces where Agnico's getting the dollar per resource at a much bigger discount to their own market implied. So there's natural accretion there to their earnings and ultimate earnings. But then secondarily, those takeout values are going to be very, very valuable to the company that's going to be acquired. So you get this nice setup where, specifically what we look for too is that we want to find those companies that have that tailwind aspect of it. So, long way of saying that, yes, the market has evolved and prices are higher, but B, the fundamentals haven't changed at all. And C, I would argue that on a risk adjusted basis, you can put a lot more money to work.
Good point. So it's quite interesting, isn't it, that in the metals sort of environment, as metal prices like rise and as producers make more free cash, tends to also help the sector and help juniors and single asset producers, mid tiers, also dramatically increase. But that tends to be when all the M&A is kind of happening. When the developers are priced fairly high, have good valuation, but it's because the producers are also maximizing their sort of like cash flow, so they get the cash to do it. There's not as much sort of M&A that happens during a bear market when maybe they could buy things at a good price because they're also sensitive to maybe lower commodity prices and mines that don't have as much margin, as much cash flow. So it's kind of an interesting, it's interesting what happens in each sort of like cycle, and how you find a sweet spot where there tends to be a good ability to transact, and it seems that we've sort of entered it with some of the rising metal prices. Anyways, just to kind of point out one of the things that I find really interesting, reading your guys's commentary and research and following you online is you're not afraid to make a call, like to take a stance, have an opinion. There's a lot of people out there that they are unsure, so they never really take an opinion. They don't put it out there to be scrutinized. They don't put it out there to maybe be wrong. But anyways, you guys have had a couple of like really good ones. I'm going to miss a bunch, but obviously you're right about cannabis being sort of overvalued. It's pretty wild time. Again, that's another one where valuations got stretched and people are like, oh, it's only $1 billion. Oh, it's cheap, cheap. And the fundamentals weren't quite there. So anyways, that was a good call for you. And then obviously you were quite early sort of on, like you said, you were early on the metals, space. I think it was back in 2019, like even before all the COVID nonsense, that you guys are out you guys are pretty excited about a gold pick, about Detour Gold, which, was acquired fairly early on in the cycle and acquired at a good sort of premium. And that was when gold was under $1,300 an ounce. Like, can you believe that? Like we're over 5,000 again. And my gosh, it wasn't all that long ago that it was under 1,500. Like, wow,
man, it's been wild, right? Like it really
Yeah.
has, right? And you know, we do put conviction ideas out there. And a part of that process is just, listen, we're gonna get things right. We're going to get things wrong. So on the cannabis side, we thought the Canadian guys were overvalued on balance, right? And a lot of that was really held within canopy growth, right? You know, we just thought that that was an very overvalued vehicle that basically just because of its market cap made everyone overvalued. Now you can argue like underneath it all, but again, there's fundamentals underneath all that. But then, you know, our view was that the US names were actually quite attractive at that time. But then as time evolved at, you know, where the clock was ticking, that valuation window closed really quickly, right? Like it's like, you know, so for us, yes, you know, our view was preference US, but like if you look now, man, it's so I think for us something important is that we're going to get things right and wrong, but exiting stage right at the right time is everything. Like that actually is everything, right? And so we've had great calls on the mining side. We were early on beyond it, really worked beyond me. And then when operational problems started, we were like, wait a minute, what's happening here? And then, you know, our weights are out in the open. Like you can see all our weights in our ETF going all the way back to when we started in 2021. We had that thing sub 1%. We just kept trimming. We're like, you know, this is not like, it's not going to turn out the way, you know, the risk reward starts to get challenged. So for us, that was one where, yeah, we got the call wrong, but like, you know, we weighted it right. Now the flip side of that is we were heavy in NVIDIA early on. And that like we had a higher weight in NVIDIA than every other growth fund in America. We were at 23% at the peak. And we're like, you know what? There's one way to play this, and it's clear as day that it is NVIDIA. And we were, you know, for our perspective, the quality of that business, you know, where it stood in the ecosystem, i.e., like it still is the central piece, and the valuation. Again, people couldn't get their heads around valuation trailing. And that's not the point. It's what's the valuation 3 years out, right? And that we got right. So for us, we need to make sure that when we get the calls right, the weights are correct. And when we get our calls wrong, we have to be risk managed about it. And there's really only one receipt. The receipt is the NAV that's cut every day on the ETF. And that's a public NAV, right? And so, you know, and I have a ton of respect for managers, you know, for stock pickers who decide to, you know, to have, you know, launch an ETF, launch a fund, because that means you can't hide behind, oh, well, this is a good call, that's a bad call. Here it is. You know, this is what your numbers are. And so, you know, Scott and I have tremendous belief in each other. Chris Wood, you know, we just said, you know, we know that it is the entirety of the portfolio, which is over 40 names that make a fund. So put it all together, you know, put the vehicle out there and you know, go at the largest category in the world. Like US large cap growth is F1 racing. You know, if you can win US large cap growth, yeah, you can say you have a chip. And I think that kind of, you know, you do have a trophy that is legitimate. And then ultimately, like you look at the fund and you're like, yeah, it's a process that's legitimate. These guys have the right background pedigree and you know, can I trust them to keep hitting dingers, right? That's really what it comes down to, right?
Yeah. And you guys, you know, I guess to sum it up, it's a bit of a barbell approach, right? Because you're talking like NVIDIA, but at the same time, you're talking like something like an Anfield Energy, which, you know, was a small cap uranium, you know, developer. So
yeah, it's
like you indicated earlier in our chat, it's a pretty interesting portfolio. So maybe you could explain the barbell sort of approach.
Yeah, so it's so exactly on that. On our tech side, you know, we know who has the best positioning, right? These are the large cap names with the balance sheets that are going to end up having the leading, you know, the leading models in AI. Put on the NVIDIA side, you know, these are the chips that will be used, right? Like so that kind of is the landscape there. Well understood, but for our perspective, we don't have to go far out the valuation curve there. We think that there's real value, and we've done a significant quant study looking at the historical. If you were to buy valuation sweet spot and the value of that, it's significant, and that's something that, you know, we understand well. And then the barbell of that is then the commodity side. And so there's two key levers here. We have natural gas, which we've always felt has been deeply undervalued. And we own natural gas producers that at a time we're trading on one single digit PEs, right? And so that does a lot of good things for the portfolio valuation. And then on the mining side, different way to value them, right? Like in terms of like the way we look at developers. And so we're looking at a discount to NAV. And our perspective was the small and mid cap space was exactly what you were describing. This was a space that nobody like it was,
Nobody
unloved.
wanted it.
Oh, nobody wanted it, unloved, untouched. And so for us, we went heavy on the hated. And so, like it's kind of like, it's interesting. We had one year where we had like, I think we had, so our best track record of A in the fund, not even close. It's mining. So last year we owned Lithium Royalty Corp got acquired by Altius. Like, we one year we had 3 takeouts. It was, and so, I think it underscores the fact. So if you were to tease out the mining sector as a part of our overall attribution of last year's return, so the fund did 40%, the miners did 93. But again, obviously that's not 100% of our fund. It's actually very risk weighted. It's like 8. But that is a good kind of, it's like for us, that was great. That's exactly what we want for that. Could we have a materially higher weight there? No. Like that, it's small mid cap, so we're very risk weighted there. But why wouldn't we want exposure to these totally undervalued pieces that are critical to disruption? And Anfield's a great example. We owned Hot Chili, Copper, also, and one of our favorites is Amerigo Resources, which at the time, which was really interesting, and there aren't many names like this at all.
Yeah.
So they're a copper producer. So basically they treat the water from the El Tente mine in Chile, which is one of the largest, if the largest copper mine in the world. So, you've got the effluent which has copper in it. They're pulling it out. But this thing, and they just basically pay you out the free cash flow as a dividend. It had a dividend yield of, at its peak was 12%. So if you think about it too, it's like you could go back in time and then just have this inflation adjusted thing, own it at 12% yield. They haven't cut the dividend like that. That was a very attractive time. But again, that overlays with this whole, like, how do things trade at 12% yield when they're deeply, deeply unloved?
Yeah.
And
well, that's a good name. You've got that on my radar screen, and I'm a shareholder of them. I've been a shareholder for a while since you guys, put out some great content and explained the opportunity. And again, I thought, wow, something that pays a dividend and, and that, which is still a relatively, small market cap for what it was doing. I thought was, and like you indicated, I'll take yield. I've got a few of those things where there's an opportunity to get a capital gain if you're right on the commodity or the sector, but then you're getting paid to wait in dividends. So again, good one to find, not one that's really like, that's not a name that was like really popular. You guys were early on it, and since then it's sort of caught, a few other people have caught on to it, but again, you guys were there. I think you guys are also pretty early on Anfield on the uranium space, which, again, they've got a really strategic, sort of opportunity kind of in what's going on in the US. You guys were there way before it was cool to sort of, be involved in uranium to potentially, fuel nuclear for this AI stuff. Like, I think you guys were in that before we even knew about AI models and before ChatGPT even launched. So
for sure,
you guys have been early and been benefactors of a lot of that stuff. So again, having the conviction to make those calls, and you don't mince your words. You guys are pretty direct about it. I really have to hand that to you. That's something that's sort of like fleeting, and probably you develop some of that. Part of it's probably your personality, but part of it might have been from managing capital at an institution and sort of building a process, and some of that process that you learn when you're at TD, 17 years of managing various pools of capital, be involved, wearing lots of different hats, like you said. Did that really help, in what you do as an investor now with Grizzle?
Yeah, like without a doubt, institutional background is you do put on, I think a lot of, especially growth investors, they don't appreciate risk, right? Truly, risk management, portfolio risk management is everything. Like, It's because it's easy to hang your hat on one call. Like that's exciting, but like try to put together a bunch of calls and then try to manage that portfolio and think about it deeply. Like that kind of is what we spend all our time doing, right? That kind of is like, so for us, you can have conviction on a name, but marrying that with a portfolio process, understanding the risks of it. And so, we manage the disruption at a reasonable price portfolio, the Grizzle Growth ETF, just like an institutional fund that a pension fund could buy, right? And that kind of is the long-term picture, is that we that disruption is the future of growth investing, and we believe that the Grizzle Growth ETF is the most institutionally managed version of disruptive investing. And I think like that is our big picture, is that like pension funds should be owning disruption, and by virtue, their choices to invest in disruption are very much limited because most of it is chasing that shiny object with very little portfolio construction thought.
The ETF business can be a bit of a tough business. It's great if you're if you're like one of these companies where you got 100 ETFs and, they don't really pay a lot of like great fees as a manager. That's part of the attractiveness for investors of an ETF. But any more ETFs in your future? Is it something that you've enjoyed the process? Is it something that you're applying more of your time to? Like, what's sort of getting a lot of your time, in your sort of investment and media business?
Yeah. So, great question. And for us, we do have ideas, and we do have some things in the oven that we hope to bring to market this year. Our first and foremost is, I think DARP is, we have a great opportunity here to like expand that from an AUM perspective. I think it's fair to say Scott and I, for the first 4 years of that, I can say without a doubt that 4 year period, 2022 was the worst bear market in disruption and growth equities, like in like 20 years. And we came away fairly unscathed. Like we were down 19% in 2022. And just for perspective, the Nasdaq 100 was down 30 and change, and ARK Innovation was down 67, and the S&P 500 was down like 19 or something. So like bottom line is we kept in line without owning any defensive with the S&P 500. So we're very happy with that. And then if you look at a very strong year of growth like last year, so 2025, we were up just over 40%. ARK, again, this is a beta strong year. They were up 35 and change. So from our perspective, there's an asymmetry here of what we're doing, and so it's exciting. We're on this new marketing push in terms of like getting people to understand the value of disruption at a reasonable price, and how that can fit in a portfolio. So that's very real, and yeah, we're looking at other opportunities. So I'll definitely keep you posted on that side of what we're
Yeah.
exploring. So yeah, and we're also interested in ETF research and strategy. And so the bid ask ETF strategy and research, which we're gonna we started publication, and now we're gonna push back out there, which I think like there's just isn't enough research in the ETF industry, good research about how the markets are evolving. So we're excited about that as well. So I think research for us is always still very near and dear. It'll always.
Well, I'm excited to hear about the research for ETF because again, a lot of the ETF stuff has become very like commoditized, where it's like big firms that are like packaging these things up, and they have very limited sort of like sell sheet type stuff, and they just do the initial sort of like push to like get it launched and out there, and then it's really just on performance, whether an investor is going to continue to sort of own it and whatnot. So that sounds like an exciting thing. I think that's a really interesting bridge for somebody who's following you individually or subscribes to your guys' like Substack and gets to know that you're involved with a New York Stock Exchange listed sort of ETF. We don't necessarily see a lot of that on the Canadian, somebody who's living in Canada talking about the Canadian markets a lot. We don't really necessarily see a lot of that crossover. However, we are starting to see a little bit more of crossover in the metal space with some of these sort of, emerging sort of producers that have decided that maybe, the venture exchange and the TSX maybe isn't enough for them. And we've started to see a few of them hop onto, NYSE sort of listing or NASDAQ listing really helped to try to get some of those Robinhood investors and bigger pools of liquidity. So we're starting to see a little bit more of that for some of them. But why don't we sort of talk, talk metals a little bit? Like we're kind of joking a little bit a minute ago about gold. Wasn't all that long ago, 5-6 years ago, it was $1,300 an ounce, and today it's over 5,000. We just went through when we bumped into each other in Vancouver the other week, was right when silver was, going, over $120 an ounce there. And I think, when we were thinking of a thesis, probably when we were thinking of a thesis originally of silver, we thought, oh, if it went to $50 an ounce, we'd be happy.
Yeah.
So it sort of, I would say, kind of maybe overshot. What do you think? Again, this is a personal sort of opinion. This isn't, I'm just asking, what do you think is kind of driving these things? Is this normal sort of catch up? Is it, central bank? Is it the QE forever phrase that you've sort of coined? What's going on with this stuff?
Yeah, so I think all of the above, check. I think what's the most interesting there, so you have all of those points which are all clear and correct, and they're not going away. Then the other additional aspect, which is very intriguing, is what's happened to Bitcoin. It's completely come undone or uncorrelated with what should be a store of wealth asset class. And so we think there's a lot of risk capital that was chasing these characteristics of store of wealth and now is realizing, wait a minute, if I take a view, like let's go back 5 years, right? 5 years, the Bitcoin investor was I'd call it kind of more like akin to the silver investor that we've always known about, right? Like kind of like the hoarder of silver and, I'm not going to let it go. World's going to end. Listen.
Diamond hands.
Exactly. Like this is as diamond hands as it gets, right? And so I would say there's no question if you went 5 years ago for Bitcoin, that it was that same school, same church of investor, right? Like diamond hands, there's nothing that's going to shake our confidence in this asset, right? And if you fast forward to today, that confidence, you have to rate that confidence. I would say you have to give it, if it was an A plus then, I would say you're lucky if it's a C now. And let's talk about that. Like, what does the C now mean, right? Well, like the church has gotten bigger, no question about that, right? And the last group that have entered the Bitcoin parish, if you so to speak, right, has been basically like these are mom and pop investors that are basically just generic retail people, right? Like in general, plus some advisors, etc. Like these are not like, people who have strong conviction about Satoshi or anything like that. Like they don't care about any of that stuff. They just care that you sold me this thing that was store of wealth. I hope that it's doing store of wealth, and I'll reassess every year. So when you think about a big picture, why is the confidence around Bitcoin a C today? Well, the bedrock of that is we're looking at a world today. If you look into the future, 5 to 10 years, there's enough doubt that quantum computing, and just, the state of how much compute that we've created because of AI, that there are real risks to, quoting Michael Saylor, the hardest money on earth, which I don't know, man, the hardest money on earth is actually gold and silver, right? And so that's actually hard. Like you could feel that physical.
Yes.
And so, the combination of now there's some question marks around the certainty of the blockchain, Bitcoin, and without it getting compromised, and then if you talk to people, they'll say, well, listen, even if something happens, it'll get it'll get forked, and life will move on. And we'll be like, but like the question about that is, well, who's doing the forking? Because like that to me is now, you guys were railing all the time about central banks. Well, now you'll have a central body that tells you how we fork Bitcoin, and that to me doesn't sound very hard money independent. Like no one's forking gold. It is what it is. And so I think that fundamental is is critical, and it's it's something that the market has to digest, right? That there is more risk now to Bitcoin in terms of at least perceived risk, and that's all you need. And the last amount of money that went into Bitcoin is probably the most paper hands, using those terms, right? This is not the most diamond hands tranche of money, and it was a lot of money. And so that, once you rewind that out, I think you have a lot of money that is looking for a home, that wants the same characteristics that Bitcoin had on the package, so to speak, or the tin, right? And
Right.
so, and there aren't a lot of choices, right? If you want a inflation hedge against monetary and fiscal misallocation, right?
Yes.
Like literally you're talking hard assets, right? And so gold and silver are like the premium, of gold being the premium, gold and silver equities underneath that giving you the beta. And then finally, yeah, then you're going to get into other commodities, but those other commodities, let's be frank, are a lot more tied to the global economy, right? Like, so I still don't think you can put copper in there. It's too tied to the way the world, run. Like people are still not on on you know on balance in any way, shape, or form buying copper as some sort of hedge.
Sure. And we're hearing this term come up a lot more. You said a bunch of things. There's lots to unpack. I'm not sure exactly where to go, but I'll start here. We hear this term multipolar, where there used to be a unipolar world, and there used to be this sort of idea that we had global trade, and so maybe some of that stuff is changing a little bit, and there seems to be this rapid sort of nationalization sort of approach that different regions are kind of taking. The U.S. Looking to rely less upon other countries, the EU looking to maybe rely less upon other countries. Is that playing a part as well in sort of the sort of rise in sort of prices? Just now there's sort of a rapid understanding that maybe it's been uninvested, and that you can't rely upon far off potential global partners anymore if there's trade conflict.
Yeah, I nailed it. For 100%, that's a huge tailwind for what we believe is a correct recalibration towards hard money assets as the bedrock, right? And I think a big part of that is having the US dollar as the world's reserve currency was highly beneficial. Like I don't really take, if you think about the last 40 plus years, right? This has been in a period of the US dollar being the world's reserve currency. Like my life is better. I think everyone's lives are better but all good things must come to an end, and there's a whole host of reasons. But I think that in a world that a certain currency isn't viewed as the bedrock reserve currency, central banks around the world are going to say, well, and I don't think it's as dramatic. Like, it's just on balance. We're going to add a bit more gold. We're going to, to our reserves. And that act of just on balance in a market like gold makes a big difference, right? And ironically, that's what the Bitcoin guys were always, El Salvador buying Bitcoin, like they didn't matter, right? But like,
Sure.
China buying a lot more gold matters. Russia buying gold for their reserves
Sure.
matter. But, their hope was that like some of these big central banks would say, yes, we're putting Bitcoin in, as a part of our central bank reserves. Like that obviously would be a massive change, right? And so, let's talk facts, right? Canada does not have gold in its reserves. Like that's insane. And so, just from that perspective, if we had anyone thinking correctly and said, we got a U-turn on this, and specifically now, right? What do they, like that, like, and Canada's on it, nothing country, like, to go from selling all their gold to like now having to replenish reserves, that that matters on balance, right? And that and that plays through globally, right? Probably not as dramatic as the Canadian example of
Sure.
the fact that it's one of our greatest exports too, which is quite kind of crazy.
Yeah.
But like I sincerely hope that we can realign things and be that the Canada can be the great commodity country, both as a producer and ultimately what backs the Canadian dollar, which is not hopes and dreams, right? It's not.
Right.
It's got to be based on fiscal
Yeah.
responsibility and hard assets behind that currency.
Right. And then just to finish the Bitcoin, obviously we're not going to dive into it. We don't want to get into all this conspiracy nonsense, but there's been some files released recently, and maybe it questioned a little bit about the origin story of Bitcoin and maybe how beneficial certain capital was and who developers were. And do you think that's also sort of clouding it a little bit and caused some pressure because maybe it's not as like a pure history as maybe some had hoped?
Yeah, there's definitely the no, it's a like the treasure trove of emails in that whole Epstein world has been I like it's just nothing short of just incredible. Like in a lot of ways, there's like a voyeuristic element of the like seeing how a total different class of very wealthy people have lived their lives, right? Yeah, and the fact that there are emails there that are that paint some doubt into, or at least showing that the cards again may have been tilted. The thing that I found the most interesting, which someone had highlighted, like there's just such a phenomenal treasure trove that if you kind of look at it, and I get to your point, like maybe some of it questions Bitcoin, but if anything, it should just question the foundation of what we believe is to be a fair state, etc. He had won like the lotto. Like, so his holding company had won
I
like a
thought he
four.
won it I thought he won something.
Did he win it twice, like a $48 million? Like, I'm like, dude,
Yeah.
like, and so, like, that needs to be
I
cut.
yeah.
Yeah, yeah,
Well, I
and
think
so,
there's like a before Epstein and a after Epstein, view of the world. So, anyways, we could go much further with that, but maybe we'll leave that nonsense to other
yeah, yeah,
content
yeah,
creators. We'll stick to
yeah, yeah,
the good stuff, the wholesome stuff.
yeah,
You're a family man. I'm a family man.
yeah,
So
yeah,
we got
yeah, yeah,
our own children to sort of protect and do the
yeah.
best that we can. What you talked about your conferences. So a lot of these are kind of like virtual conferences, like online sort of conferences. Is there any sort of like cost for like attendees to sort of attend these? How do they sort of register? How do they get on a list?
Yeah,
When's your you mentioned you got a PDAC conference coming up. That's an in-person one. Is
that's
there
in
also a
person.
live stream ability for those that can't attend in person to sort of follow along?
Yeah, absolutely. So all of our stuff is just kind of open source, so it's there out in the wild on X and LinkedIn, YouTube, so like that, where you'll find all that. And so our in person, so that it's a packed house. So if you are now, our preference is advisors, because we are obviously it's a limited capacity event. But if you're in the financial services industry in any way, shape, or form, please do reach out. Like that's kind of like a like that's it's an industry type event, but a good one. Where Tracy Shukart of X fame is she's a good friend of Grizzle's, and she's going to be there, and so we're going to have a ton of interviews and record, and it'll be out, and then yeah, and our hope is that our hope is to expand that into other in-person type events. So we're we just last year worked out so well that we're excited about what we can do, like to make it a bigger tent, so to speak, right? But this year will be a lot of fun as we think about other opportunities. Tracy and I have had a lot of conversation about like how we can expand that to be, like I think in person is so exciting, and it's like there something definitively missing in the market. It's something that, like, there are a lot of great in person conferences, don't get me wrong, but in general, I would say while we love our virtual, and I think like we try to do it like keep it a lot of fun and keep it like high energy, live through the piece, but in person that's like legit live in person through the piece. And so, for us, it's a great balance. And our hope is to like continue to build that. And we've had a great for our conferences. We have a great number of phenomenal sponsors, all the way from mid cap names to the very large cap companies. Agnico was an early guest on it as well. So our hope is to continue to grow that and continue to spread insight and knowledge into how the mining markets work.
Awesome. What are a couple of like themes that you may want to talk about that you think are important for the next couple of years that we should think about? I'm not sure if your feed was as crazy as my feed, but my feed lately has just been AI everything.
Yeah, yeah.
Apparently I'm doing it all wrong. I gotta get a open claw or multibot or
Yeah,
club mod or something.
and the name still keeps changing ever so much. No,
Yeah.
yeah, yeah, it's interesting. I would say we've had a sweet spot in AI, and that's reflected in the fund, and that's been a great, it's been a great win for us. Now the whole question of where are we in the game, the 9 inning game, are we in the third inning, sixth inning, it matters a lot, right? Obviously, I don't think we're in the seventh inning stretch or eighth inning. Like, obviously that'd be a different space, right? I think if we were to look at the opportunities that we see right now, and the types of productivity enhancements, we would reckon we're in the fourth or fifth inning, right? Now, what you own matters a ton, and which is quite exciting. Google's our top pick there. We think, they've got almost every box checked off. And just even for myself, I'm still amazed. So I think they've reached that part where if you could think about a technology that can revolutionize productivity, that technology would be to give everybody an executive assistant, right? So anyone I know that's a high performer has an executive assistant. And usually that's reserved for very, very big companies that, this is but if everybody were to have an executive assistant that could line up everything you're doing today, get also be a productivity coach and all that sort of stuff, that's not a fairy tale anymore. That's very real. That's actually here right now. And that, I was using it specifically, the Google ecosystem, which most people are connected to. You could just say, look for this email sent to the, that I sent out, from my last invite to my party, highlight all the people, tell me the emails, let me know who I invited, because I just was sending stuff out, and it can take me a long time to fish this up. I get a beautiful table, everybody who I invited. I'm like, this is incredible, right? And and I've used Gemini for a whole host of different things where I'm like, listen, lay out everything I got on my calendar. Tell me what, give me a sprint plan. And it just is incredible, right? And I think we're there's no question we're still scratching the surface of the productivity enhancement as a society, right? I may be more, I may be using it in a more productively enhanced way, but I can guarantee that the people that I talk to that aren't, obviously interacting as much with AI as I am, 9 out of 10 of those people are not even close. It's not even, and I would say that's a real opportunity in the sense that everyone has mundane things in their lives that AI should get rid of. And that's a good thing, right? Nobody wants to just enter numbers into an Excel spreadsheet. That's not a good life.
I know a few people and they really enjoy that.
Yeah. We got to
I'm not one of
reprogram them.
them.
We got to take them to reprogramming camps. Get that.
Yeah, I'm pretty amazed. I try to stay up on some of that stuff. I have kind of an adjacent sort of business, which has been greatly improved with the implementation of AI for different productivity and
Fantastic.
things like that. But I'm also pretty try to be, and again, I'm getting a bit older, so maybe I'm not like the kids these days, but I try to stay up on new tech. Tech's always been rather interesting. So yeah, it's definitely seems like it's accelerating. One company drops a model, a few days later the next one comes out with one. They try to one up each other.
Totally.
Pretty interesting. I think we're starting to see some evidence that AI is affecting sort of jobs, but also making companies more profitable or more productive. Is that a theme that we should continue to watch for?
Yeah, there's no question about that, right? We're gonna see a lot of dislocation. I think there's a good chart floating around in terms of just youth employment, right? That's this is the first place, which is really unfortunate, where AI is taking the fundamental of AI is that now I can everyone's got somebody that is kind of they're very green junior, right? Kind of thing, right? And so that actually has an impact on the person who is actually a green junior, right? And so I think we're gonna have to address that. And I think that's done at the educational level. Like, I don't think, like, I think like there are a lot of young, smart men and women who are addressing that right now. I think it's an opportunity. It isn't as so much of a risk. But then, there's a huge amount of people that are, that are going to feel the impact of AI and how that plays out. I do have some views on what happens there. They're like, I will say this, right? When the computer came, my dad was on the typewriter. It was enough of a curve that he could kind of get into the computer. Like, that was like, this is like this. So the step change here is like, for anyone saying it's not, if anyone saying it's not going to leave like a group of people behind, it actually is true. It is going to, and like, society's going to have to figure out what that means, right? But it doesn't mean going technologically back. I think you kind of, there's ways we can address this, but I think the other part too is that like there's going to be some sort of basic income that's going to be part. Like, I'm just being real, right? And so whenever I hear basic income, it's not good. And so I just think like printing money and stuff, right? And so that backs hard money, right? And so
Yes.
and so if you were to play out AI to its final point, I think it does improve lives. Absolutely. I recently had just posted too, like, I never really had done a physical or anything like that. And then I just did one, and high cholesterol and all this nonsense because I love eating and, and then, and I had to U-turn all that shit. I had to U-turn it all. I would not have been able to turn my numbers around without, AI, when I specifically. All credit due to the AI model. I can say that very factually. That that whole aspect of me kind of getting my numbers around was like, I'm going to the grocery store taking a picture. I'm like, give me green light, yellow light, red light. And it was doing it to a level of like, you'd be at a restaurant. Like, so that kind of coaching was previously reserved for elite athletes.
Right. Well, there you go. That's good. Well, I'm glad to hear that you're getting your diet in order. And
Well,
I haven't seen so many. He used to post some great photos of really, really tasty food that I thought, man, if I have that, I'm gonna have a heart attack. But I really enjoyed the picture.
Oh man, yeah. There was a cost to all that.
Yeah. Yeah.
No, you know what? That
Everything in moderation, I guess.
totally.
Yeah. So as you've 2018 you launched Grizzle, and it's 2026. Boy, time flies.
Totally.
Was there ever a time when you're like, man, I made a mistake, I shouldn't have done this, or has it just been amazing all the way through?
Yeah, I know. Like it's if it was all like roses, I think everyone would. No one would work in like a everyday job. Like no, they're like through time. Like it's hard, right? It's like I think you wake up every day and you ask yourself, do I still have the conviction on the future that I see the world being the future? And what does that conviction require? That requires you to continue to manage your fund, even though it has a lower AUM and it'll get higher, but that the world will come around to that view, right? And that conviction is kind of all that you got as an entrepreneur, right? You have this conviction that your view of the world is correct, and it won't come to fruition tomorrow because that'd just be too easy. And then over time, bit by bit. And I think Dave Portnoy used to always use that word, like brick by brick, right? Like, that vision gets proved correct. You hope, right? Like, again, that's all kind of, you can be right or wrong, but, and I think that's kind of, as long as you wake up and you believe your conviction, that nothing's wavered your conviction, go full steam. You got nothing to lose except everything, right? Like, it's just kind of like, what is your, like, if you believe in something, like, go for it, right? Because, like, what's the worst that can happen? Just start over again? Yeah, who cares? Like, but this kind of gets more to the heart of the matter. Like, yeah, do I wish I was back at an institution? No, not at all. Like, not at all. And I think that kind of is, and do you think I don't think my numbers would be nearly, not even close to as good as they are, because, a big part of our investment process, Scott and I, was developed outside of the bank. Like, we would not have been able to think about everything as radically as we do today. And that was truly a function of the fact that we were not limited in any way, right? We could just be like, what, like,
You got your barbell approach, and that's not typically something you'd find at XYZ big institutional fund, because they tend to be pretty siloed, right? Like if you're going to buy this, it's gonna like an energy, it's gonna be energy concentrated. If it's gonna be like a Canadian growth, it's gonna be pretty wide Canadian growth. You won't necessarily be able to skip out some stuff. So I guess another question for you. I know we're running on. It's been really, super entertaining, and you're obviously very likable, got lots of information. I love how you think about things. I often send you DMs saying, man, I really enjoyed
Oh
that.
man, thank you. Yeah.
We also heard a bit about, hey, AI is going to put SaaS out of business. Is this becoming a hated sector, SaaS? Like, what do you think on that? We've had a whole generation of Constellation Software fanboys get spanked here recently.
Yeah, like it's man, dude, you gotta hit it on the head, right? Like it's so we're fortunate, but like we have no real exposure to SaaS, like none, zero. And so we did have exposure to SaaS, and then we'd taken that down a lot during the 2022 bear market because they were exposed. Like their multiples have always been exposed, right?
Yeah.
We'd taken that down, and then subsequently the AI revolution started, and we found like the value opportunity in AI in terms of Nvidia, the stocks around Nvidia were far more valuable for us in the portfolio than owning SaaS, and so we never really revisited it. We always would look, and today I would say, is AI going to eat SaaS? Definitely parts. There are going to be questionable parts. I think the more important question is, will AI eat the valuation premium of SaaS? And the answer for
Yes.
Constellation is absolutely yes. And this is why Constellation was always at a premium, right? And so if you look out to the future, like that premium is very much like Bitcoin. You get a premium if I have confidence that the world is perfectly aligned and there's no risk to your business. But that premium erodes completely when doubt is sowed, right? And I just think that valuation is still, we've looked at it, valuation is still
Too
expensive.
high.
Yeah,
Yeah.
it's too high. And I'm not talking about Constellation specifically, like
Sure.
that's
Yeah.
right.
You're just
But
talking
just
about the sector in
SaaS
general.
as a whole, that it's too high. Again, so again, this is not a question of does the model work or not. Like that actually is actually totally secondary. The most important thing is that these companies can continue to hit continue to hit revenue top line, and the stocks may go nowhere to down for the next 5 years, purely based on the fact the market has now significant doubt whether somebody can vibe code something that basically like kills Monday.com. I think more critically is that there's a lot of damage under the surface. That there are a lot of companies that were private, VC funded, that will never see daylight. The bigger question is what happens to that reverberation of these VC funds when they ultimately have to take goose eggs on a lot of the companies that were SaaS companies that now are like, wait a minute, we're not even gonna get a chance to come out to go.
Right. Well,
I don't think
they're probably all going to be turned into AI companies pretty quick.
Yeah, it is.
You're now going to develop a robot. You're getting into hardware.
Totally. And if you don't do that, then no.
Yeah. Well, anyways, that's great. So, you guys also publish paid Substack. That's where people can get some of your research. What's the best place for somebody who's watching this who's like, yeah, I want to plug in? Where do they go? What's your website? What's the place where they can find all the information and choose where they might want to subscribe and plug in?
Yeah. So if you want to learn more about the ETF, etf.grizzle.com. If you want to learn about our research in their Substack, research.substack.com. We do have a quantitative like overview, like how we think about the sectors. So that's how that plays out. And then just in general, if you want to find us, my X profile is where it all kind of starts. Is that at Thomas G _Grizzle, and that's on X. And then that's where you can find all the other conferences. Like we usually stream the conferences through my handle as well. We do Twitter Spaces and all that sort of stuff related to the market.
Yeah. I don't know when you sleep. You got a lot on the go, but that's okay. I'll do the sleeping for you. So what's maybe the last question? What are two things you'd like to leave viewers with today?
Yeah, so I think two things that are interesting is that there is a high degree of interplay between AI and commodities, and that both of these themes, in our view, will work, right? And so I think that if investors think about how they can invest in this market, you don't need to own the mushy middle, right? I struggle, and again, many investors have these placeholders in the S&P 500 ETF or the TSX ETF. These things all have like a lot of mushy middle that we just think like, what's the point? To be totally blunt, right? Like, what do you get by owning a telco that ultimately the government will say you can't increase the price of your thing? You know what I mean? Like, people are going to get hurt. I just think bigger picture, there's going to be a lot more, and those companies aren't interesting once you strip away the valuation. Again, like a lot of these very boring businesses are actually valued very high, right? At least I can say, the tech companies, the ones that are valued high, actually have filled in that valuation quite nicely. And you can't say that about a lot of that mushy middle. So I would say that's one area just to be careful of. But the barbell of AI and the future-facing commodities is a great one. There's a lot of interplay between the two. Obviously, critical minerals are key. But the other side, too, is that gold and silver will continue to be key, because if you think about it, countries do not want to be left behind. And a big part of the way that they're going to stay in the mix is by using their balance sheet. So countries will use their balance sheet to ensure that they are part of the conversation when it comes to AI supremacy, be it through funding data centers, energy that feeds it. Like there will be a lot of subsidization at the governmental levels that ultimately will be felt through higher commodity prices, and you just want to be faced there. So I think that the takeaway here is like, don't own the mushy middle if you don't have to, and most people don't have to. Stay long AI, stay long future-facing commodities. Like, this is not going away, and then always have a valuation lens, always.
Excellent. Well, Thomas, I really appreciate your time. Very, very informative, very entertaining. You keep it real. I really appreciate the time, and thank you.
Thank you so much for having me on, and I look forward to seeing you at PDAC.
Yeah, absolutely. Look forward to seeing you. All right, man.
Thank you.
Thank you.